Welcome to Accounts by ARD, your accounting coach. The topic of the day is not-for-profit organizations or club accounts. Now, what is actually a non-profit or not-for-profit organization? A non-profit or not-for-profit organization is an organization whose primary objective is not to earn profits. Primary objective is not to earn profits. So, what is actually a primary objective? First of all, you need to understand that not-for-profit organizations sometimes makes profits, and at times a not-for-profit organization makes lots and lots of profits. I can give you an example that your CIE examination body, CAIE, is a not-for-profit body. Some of you feel amazed and some of you feel surprised by listening to that the CIE organization is a not-for-profit organization. Do you strongly believe CIE does not make any profits by its operations? CIE makes lots and lots of profits, but again, why does CIE list itself as a not-for-profit organization? Because CAIE was not founded with the intention of making profit. But why are they making profit? The difference is that the primary objective of any not-for-profit organization is not to make profit, but the primary objective is to provide some non-financial objectives, such as to promote education, such as to promote some sports facilities or sports or recreational facilities, to promote some cultural values, to promote some ethical values, to promote some healthy exercise or maybe some medical facilities relating to healthcare. There can be some facilities relating to education. There can be some facilities to promote games and all this stuff. So these are all basic objectives. There can be objectives to remove poverty. There can be objectives to reduce unemployment. So there can be n number of objectives that are known as not-for-profit objective or non-financial objective. One more important difference between a profit-making organization and a not-for-profit organization is that the profit that not-for-profit organizations are earning cannot be taken back to the home. They cannot be drawn out of the business. There is no concept of drawing in not-for-profit organization because not-for-profit organization is not owned by someone. No one can claim that I am the owner of Red Cross, that I am the owner of maybe Alamgir Welfare, or I am the owner of Shipa Welfare or Edi Foundation or Shaukat Khanam Cancer Hospital. Imran Khan Saab cannot claim that he is the owner or he is the real owner of this or shareholder of Shaukat Khanam Cancer Hospital, because there are no owners in charity, there are no owners in not-for-profit organization. Karachi Club, Muslim Gymkhana, Edi Foundation, Aman Foundation, these are all not-for-profit organizations. These are made with an objective which is not of making profit, although they earn profit, but this profit cannot be taken to the home in form of drawings or in the form of dividend. The profits that not-for-profit organization earn is reinvested for the same cause, is reinvested to further promote our non-financial objectives. Although the board of governors, there are no board of directors here, there are board of trustees or board of governors, they can take salaries. And at sometimes not-for-profit organizations are basically accused of stealing public money in terms of fat cat salaries. The board of trustees or board of governors themselves take out huge sums of money from these not-for-profit organizations and actually exploit their organizations for their personal gains. If they cannot take out drawings out of the business, they take fat salaries in order to take money, in order to skim out the profits out of the business. Now let's move further. Let's see the accounting aspects of these not-for-profit organizations. As you may be aware of your earlier studies, that we need to make an income statement for any for-profit or any commercial organization, commercial business basically. So in a not-for-profit organization, basically there are two kinds of income statements. One income statement is known as a refreshment income statement. The words that are used in an examination question are refreshments, or it can be canteen, it can be cafe, it can be termed as cafeteria, it can be termed as shop, maybe book shop or wine shop or sports shop or clothing shop or whatsoever. So it doesn't matter what word the examiner used, all basically mean the same thing. It can be cafeteria or canteen. So most common term the examiner uses is refreshments. Refreshments mean the things that we use to refresh ourselves, mean the cold drink or water or energy drink and all this snacks and these all stuff. So a refreshment trading account, a refreshment income statement. So maybe in an organization, maybe Karachi club, there is a canteen, there is a cafeteria. We need to make a separate income statement for that cafeteria, which is known as canteen income statement or sometimes known as canteen trading account. So this is just like a normal income statement. This only difference is that everything in this statement will be coming for refreshment, will be related to refreshment or canteen. Again, sale will be of refreshment or canteen, then cost of sale, opening inventory, add purchase, less closing, everything will be of refreshment, canteen. Then cost of sale minus cost of sale, gross profit. Normally there is no return inward, return outward, because these refreshment are food items. These are not normally returned. Neither by us or by our suppliers. Then gross profit, then we need to deduct expenses. Expenses will only be deducted if there is expenses relating to refreshment or cafe or canteen. If there are no expenses relating to refreshment or there are no expenses tagged or labeled as canteen expense or canteen staff wages or refreshment rent, refreshment area rent, if there are no expenses labeled or termed as canteen, so we won't be charging any expenses here. We just need to make this till gross profit. But if there are expenses relating to canteen, these also need to be deducted in order to get the final figure of profit from refreshment or profit from canteen or profit from shop. So this was one income statement that we need to make, and the another income statement which is more important is income and expenditure account. Income and expenditure account is basically an income statement for the entire organization, entire club. So it can be any organization. We need to make it may be a charity hospital, it may be a state owned school or state owned university. So this is an income and expenditure account for whole college or university or hospital or a club. There are only two headings here in an income and expenditure account. One is income and one is expenditure. So as you may be aware, there are two columns always in an income statement. These are not debit credit, these are just for presentation. We'll be writing all incomes here, then adding up here, and we'll be writing all expenses here, then adding up here. There can be income as profit from sale of refreshment. Now how do we calculate profit from refreshment? It has already been calculated by us with this statement, refreshment income statement. So this figure will basically come here in income. If there is a loss from refreshment, so we'll be writing that loss in an expenditure heading here, in an expenditure loss. And then we have other incomes such as gain on disposal. If you have disposed of some old furniture or maybe a motor vehicle, then the gain comes on income side, and if there is a loss on disposal, it will be shown as a expense. Then we have other incomes such as sale of tickets. Now what is this? Sometimes a charity or club needs to raise finance in order to run its operations. The finance can be raised by n number of ways, one of which is arranging some sort of seminar or exhibition or maybe a concert or maybe a competition or quiz or a match maybe in order to attract public, in order to sell tickets and raise finance. Okay, so sale of tickets is basically an income. Maybe it is a concert or maybe it is some sports event. So sale of tickets will come in. Sometimes there are also expenses relating to such events. Maybe we have sold concert tickets, and the sale of concerts is basically we have sold tickets worth $100,000. And in order to arrange that concert, we have hired some band, and we have arranged some catering such as food. Maybe the total expenses for this concert was 60,000 and the income was sale of ticket was 100,000. So we do not need to write 1 lakh here in income and 60,000 here in expense. We need to net these both things, that is 100 minus 60, in order to get the final profit figure of 40,000. So that final figure need to be calculated and shown as an income. So the final figure, if it is a negative, therefore it is an expense, it will be shown as loss from concert, and if there is a profit from concert or match, it will be shown as an income. Now why we are netting it, and why can't we show this income as sales separately and expenses separately? We can also do that, but there is a problem in that, and the examiner does not like this approach. Why? Because we cannot actually calculate the net effect of this event on the company, on the club's financial statement, because the management need feedback, the board of trustees need feedback, so that further such events should be organized or not in the future. Because if the event is not beneficial for the club, it won't be need to be repeated again. Okay, so after that we have subscription income. Now what is subscription? If we are running a charity, or maybe there is a club, it can be a gym, it can be some sports, indoor or outdoor sports courts, it can be a swimming pool. So all of these facilities need to be maintained, and to maintain these facilities we need money. And how do we raise that money? We'll be charging a small amount from our members, and this is known as subscription income. Now how do we need to calculate this subscription income? This subscription income need to be calculated using a T account, which is known as subscription account. Let me show you how to do that. Now see, there is a subscription account. Subscription is an income account. For we need to calculate this, make an income account. In order to understand this, you must have been gone through to a topic which was accruals and prepayments. It is basically a very important topic, accruals and prepayment. As this is an income account, if you have already gone through my lecture for accruals and prepayment, you can easily understand this account. For income, we use a mnemonic of APPA, A, P, P and A. It is also known as OPO. OPO, this is owing, prepaid, owing. You can remember this by OPPO as well, as OPPO is a popular cell phone brand, Indian brand. So you can use the mnemonic OPPO. Owings, prepaid and owings. Accrued and owings means the same thing. Now what is accrued and owing income? This means that we have provided services to our members, but there are some members who had not yet paid their monthly subscription. So this subscription is an asset for the club. So the asset always comes on debit side. If the opening balance BD is coming on the debit side, then balance CD should always come on the credit side. And if there is a prepaid subscription is basically a liability for the business. Why it is a liability? Because the members have paid us some amount in advance. If the members have paid us in advance, but we have not yet provided services to them, but if we fail to provide this service, we need to return their money back. So therefore it is a liability. Prepaid income is a liability. If opening liability is coming on the credit side, the closing liability always comes on the debit side. We can remember this by with the mnemonic APPA or OPPO, OPPO or APA. If we are receiving money from our members, we need to make an entry bank debit, and subscription account will be credited. Bank is debited because the asset increases in debit, and subscription because it is an income account. Income always increases in a credit. And if the members are paid at the greater amount, then they are requested to so we need to return this money to members back. So what we need to make an opposite entry. Bank account will be credited because money is going out of the bank, and the subscription account will be debited. Now why this subscription being debited? Because it was an opening liability for us. We need to pay that money, and we have returned this money to them. Therefore we'll be debiting this. Subscription refund will be decreasing our liability. Then we have bad debts. There can be a bad debts in the subscription account as well. Means some of the members, after using the services, left the country, or they are unable to pay us the subscription due because of their financial conditions. Therefore it is a bad debt for the organization. Bad debt or irrecoverable debt will be debited, and subscription account, the debtors will be credited. Then at the end of the year, the balance that remains in a subscription account will be transferred to income statement. In this case, we'll be using income and expenditure. Subscription account is basically a credit, basically an income account. So income will be debited. We need to close or reverse this account and transfer it to income and expenditure account. So subscription account debit and income and expenditure account, that is income statement, need to be credited. So this is the basically the figure that we'll be using in an income and expenditure account. This is a figure. Now let's discuss some other items. Rent of hall or premises. Sometimes in order to raise some finance, a not-for-profit organization can rent out its premises, maybe for exhibitions or for some other purposes. In Pakistan, maybe we are using it for a marriage wedding ceremony hall. So this is rent of hall and premises. We are earning money through letting our premises to our tenants. Then we have donations. There can be two types of donations in a not-for-profit organization. One is revenue and one is capital. Revenue, as you are aware, revenue items mean day-to-day items. So if we are getting small amounts of money from many number of people, so donors, this is a revenue donation, and revenue donation always comes in income and expenditure account, added as an income. If is not mentioned in the question that donation is revenue or capital, we always assume the donation is revenue in nature and will be adding it up here. If the donation specifically says that receipt, or maybe the examiner says that donation is for specified purpose. Now what is the purpose? Maybe some person give us donation, and the donor give us donation, and he specifically mentions this, that I am giving you 1 million rupees or dollars, and what you need to do is to buy an ambulance or maybe a dialysis machine from that donation. So that money is basically a capital donation, and capital donation never comes here. It will come in statement of financial position, that is balance sheet. Like capital donation, capital donation is also termed as gift, GIFT. If the examiner mentions gift, it is also capital donation. Or if the examiner mentions legacy, LEGACY, a legacy is also a capital donation. So these are the donations. Will be adding up all these incomes, and the total will come here. Then we have expenditure. All of the expenditure other than canteen or cafeteria or refreshment will come here, because the canteen or cafe expenses have already been charged where? In a refreshment account. The canteen expenses have already been charged. Then we have expenses, maybe wages of groundman and assistant, and then loss or disposal, depreciation, maybe some of the equipments are being used in a not-for-profit organization club. Interest on loan, if you have borrowed loan, we need to pay interest on it. If the loan is not interest free. If it is interest free, there will be no interest. Then there are secretarial expenses or accountant, maybe ground upkeep means maintenance, and there are utility bills and all this. We'll be deducting all expenses from income in order to get the figure for surplus or deficit. Now what is this? As you are aware that not-for-profit organizations are never created, never built in order to earn profit. Therefore, in an income and expenditure account, we do not need to write profit or loss. Instead, we'll be using profit for the year. In case we need to write surplus for the year other than profit, and deficit for the year other than loss. So instead of profit, we'll be writing surplus, and instead of loss, we'll be writing deficit. Then after income and expenditure account, we need to make a statement of financial position, that is balance sheet. Statement of financial position, again normally made in 3 columns. But if accumulated depreciation or provision for depreciations are not already given in an exam, so we just need to make 2 columns. So we'll be writing net book value directly, and we'll be skipping this part, cost and accumulated depreciation. But if accumulated depreciation and provision for depreciation is given for any asset, so we need to make a balance sheet in 3 columns, starting with assets, then non-current asset, then we need to list all of the assets. It's better to list assets according to the life. So land has an indefinite life, we'll be writing it first. Then building has lesser life than land, then motor vehicles, and then equipment has lesser life. Then deducting accumulated depreciation from cost, will get a figure for net book value. As you may be aware that land does not depreciate, therefore I have not mentioned accumulated depreciation for land. Cost minus accumulated depreciation, also known as provision for depreciation, is equal to net book value. And now cost and accumulated depreciation, we do not need total for this, but for net book value we need a total. Then after non-current asset comes current asset, we'll be writing inventory. Inventory will be of shop or canteen or cafe. So inventory will be there, and there are no trade receivables there because we are not normally selling any goods on credit, but we have an important current asset, that is subscription in arrears or owing. Subscription in arrears already been discussed, means we have provided services to our members, but some of the members have not yet paid us the money due by them, so therefore it is an arrears, it is an asset for the business. Then after accrued income, there comes prepaid expense. This is normal if you have paid rent in advance for future years or future months, therefore it is an asset for the business. Then there can be bank and there can be a cash. After adding up all of the current asset, non-current plus current asset becomes total assets. Now after assets, normally in an accounting equation there comes capital and liabilities. But in a not-for-profit organization, we do not use the term capital, because a not-for-profit organization is not owned by someone. Okay, it is basically an NGO, or it may be some club. So there are no capital here. So if you need to write, if you want to write a heading, we can write total liability, or you can skip this heading altogether. It doesn't matter. You cannot, if you do not need to write. If you do not want to write total liability, just skip it. Then we'll be starting with opening capital. Instead of opening capital, we will be writing opening accumulated fund. Now what is this accumulated fund? Accumulated fund is basically a capital, just the name has been changed in order to appreciate the fact that it is a not-for-profit organization. There is no capital, it is not owned by some one person or group of person, so it is an accumulated fund. Now how do we need to calculate accumulated fund? As you may be aware, this not-for-profit organization club accounts is basically based on single entry concept. If you haven't studied single entry, I suggest first you may study single entry, because club accounts are made on single entry basis. Okay, so most of the concepts are here the same as of single entry. So opening capital is basically not given, it need to be calculated. So how can we calculate opening accumulated fund? So this is the format for accumulated fund: opening assets minus opening liability. So there are total assets, whether these are current assets or whether these are non-current assets. So we need to add up all the assets at start of the year, that is 1st January, and then we need to add up all liabilities again at start of the year. So after deducting opening liabilities from opening assets, we will get a figure for opening accumulated fund, also known as capital, but we won't be writing the term capital here, otherwise examiner will deduct our marks for this. We'll be adding a surplus in here. As you may be aware, in an income and expenditure account, we do not need to write profit or loss for the year. Instead, we use the term surplus or deficit. If there is surplus, it will be added because it will increase our accumulated fund or capital. If there is a deficit, we need to deduct it. Similarly, that we deducted losses for the year. Then we do not have drawings here. If you noticed, there are no drawings because the club is not owned by some one person or group of persons. So there are no drawings, there are no shareholders, there are no shares here. So then we need to add donations of capital nature, or if the examiner mentions the term legacy or gift, again this is a donation for a capital nature, we should be adding it to our accumulated fund. So then this is the closing accumulated fund. We do not need to write the label closing, because it is understood that if we start up with the opening accumulated fund, add surplus, then add donation, will be getting closing accumulated fund. Then after accumulated fund, we will be listing liabilities. Again, if you have a non-current liability loan, we need to mention it here. Again, in a loan, this percentage and this year of maturity always need to be written. If you haven't mentioned this percentage and the expiry date of the loan, we need to mature the date to repay the loan, then examiner will deduct marks. Then we have current liability, again trade payable or creditors. This will be of canteen or refreshment, trade payable. Then there can be a bank overdraft, then can be accrued expenses. If we haven't yet paid electricity bill or insurance, then this is an expense. Then there is an important thing known as subscription in advance. Means if the members have paid us the money in advance, but we have not yet provided them services, we still need to provide them service, therefore it is a liability for us. So this is the liability. Then we will be adding up all the current liabilities, and after that if we add up accumulated fund and then non-current liability and then current liability, will be getting the figure of total liability. So instead of writing total capital and liability, we will be writing the label of total liability. Again, labeling of this is important. So total asset need to be matched with total liability, and if it's matched, so you can make sure that your question is correct. So I hope students I was able to tell you the differences between not-for-profit organization and a commercial organization. So if you benefit from this video, kindly do share this with our accounting students, and kindly do subscribe my channel, and also write comment and tell me that how you like my lectures, or where are you from and from where are you benefiting from this video, means your country and city. Jazakallah.